What's up?
So what are we talking about?
Well, you gotta talk about impairment in financial assets, or what is it that we're talking about? I'm not the accountant.
Impairment of financial assets, I'm guessing.
All right, well, luckily I'm not going to be the one getting fired if I don't nail this in 3 minutes.
3 minutes is going to be quick. I'll do my best.
All right, let's go.
Okay, ASC 326 contains the guidance for impairment of financial assets. In the scope of that are going to be your loans, held to maturity debt securities, note receivables, your assets at amortized cost. There's two main impairment models. Let's start with the first one, CECL, the current expected credit loss model. All right, so the goal of the CECL model is to represent on the balance sheet the net amount we expect to collect of an asset. We're going to do that using an allowance account, which is a contra asset account, and the offset is to earnings. So we estimate our expected credit losses for the assets each period and reassess it. We can adjust the allowance up or down as conditions change. How do we come up with this estimate? Well, the guidance actually doesn't require a specific methodology to be used. Instead, they tell us to follow certain principles. So those principles are at day one, when we originate or acquire this asset, we are going to record some level of loss. We're going to record that and estimate that over the contractual life. So that means we're going to look at options, renewals, and use the guidance within there to determine if we can include or exclude those option renewal provisions. We want to, as a result of the requirements in the standard, incorporate historical data, current conditions, and our reasonable and supportable forecasts of the future. So what you're going to do is group assets by their similar risk characteristics. This is a pool. You're going to look at the historical information for this pool and adjust it for current conditions. Your adjustments are going to be things like the economy, asset quality, asset specific, things like that. Then you think about the remaining term and you're going to make reasonable and supportable forecasts of the future for the remaining term of the asset. If you can't make a reasonable and supportable forecast of the future, then you can revert to the historical loss data. That's allowed under the guidance. Okay, we need to get to the second model. Under ASC 326, the second model, found in ASC 326.30, applies to AFS debt securities. So those are accounted for at fair value each period. Each period, though, entities need to assess if that AFS debt security is impaired. Impaired means the fair value is less than the amortized cost basis. The cause of that impairment amount dictates where we are going to recognize that amount in the financial statements. So if the impairment is attributable to credit losses, then we are going to record that portion of impairment as an ACL, an allowance for credit losses, with the offset to earnings. Because it's an allowance, that amount is subject to reversal as conditions change. If that impairment is attributable to any other factors, then that amount is recorded in other comprehensive income, net of tax effects. However, there's a caveat. If at any point the entity intends to sell or is more likely than not going to sell before they can recover the amortized cost basis of the asset, then they're recording all of that impairment in earnings. Obviously, I ran out of time. If you'd like to learn more about impairment of financial assets, check out the GAAP Dynamics Learning Library for courses on all of these topics. All right, let me straighten out. Can I touch this? Is that gonna ruin it?